Hey everybody, I'm Jason. This is Supply and Demand Daily. I keep tabs on the economy so you don't have to. And today we're going to be talking all about energy because there's a really, really big war. Well, not a really, really big war as far as wars go, but there's a big war happening in Eastern Europe that has taken the blame for most of the rise in energy prices that has happened over the last year, year and a half. And that is not a good situation, but there's a really horrible political response to that situation that entails the entire continent of Europe, specifically referring to the EU countries, which there's 27 of them, if I am doing my math correctly, that are trying to completely rid themselves of Russian imports of oil, or depending on what side you're considering, could be Russian exports if you're thinking at it from their perspective. But they're trying to rid themselves of Russian oil, natural gas, coal, and basically all base necessary commodities for human life like that. And I'm doing this because I don't think there's been enough focus in the conventional media, and the folks that you see on television and all of those kinds of things on this particular issue. But also because I've seen a little bit of alarmism about just how much of these energy commodities there are and the capacity to produce these commodities that I think may be a little bit misplaced. So what we're going to do is I'm going to show you one way of thinking about this crisis, one way of picturing this crisis in a chart that makes it look really bad. But then we're also going to look at ways in which we can actually look at the supply and demand for these particular commodities at the same time in the context of the last 5 to 10 years of history, and we can get a really good idea of just how in danger we are or not in danger we are of running out or having severe shortages of these base energy commodities that we need so much. All right, so I'm going to go ahead and get out of the way so we can do all of that fun stuff, and here we go. So to cover some ground already tread, this is the crude oil price going all the way back to 2006, late 2006, and the reason that I'm showing it going this far back is because I just wanted to illustrate where we are in comparison to the last major peak in oil prices, which was September of 2008. If you're familiar with your great financial crisis history, this is when a large investment bank called Lehman Brothers met its bigger end and was not saved by the combination of the Federal Reserve and the Treasury. This was the epicenter, time-wise, of the great financial crisis of 2008. Now, what is the biggest low in this series? Well, oil prices actually briefly went down to negative $30 a barrel, which I don't think is exactly shown on this chart because this is a front month futures chart, but they went down to about negative $30 a barrel in March of 2020, and that was associated with the low amount of oil being burned and consumed, along with the coincidence of the COVID lockdowns. Okay, so that's what we're looking at here, and we're currently sitting at a price as of Monday close of 110.69. So that's where we're at. There's been a precipitous increase in oil prices going all the way back to this tiny minimum in March of 2020. And it really started to pick up in 2021, even though you can't really see that entirely on this chart. And then there was definitely a big boost with the Russia-Ukraine war, a big boost in price as well as volatility. All right, so but another just interesting thing to look at with this chart is where exactly could oil prices go? Well, the structure of prices is very different now in 2022 than it was in 2008. Specifically, all prices have gone up, including wages, which are people's capacity to pay for these different sorts of commodities. And so it may be a useful exercise to inflation adjust the previous peak to get an idea of, just how far oil prices could go if supply constraints really persist. And where that is if you just take that peak oil price, which was $145 a barrel, $145 a barrel in September of 2008, and you inflation adjust it to 2022, you get $202 a barrel, which roughly corresponds to a gasoline price of $6.74. That's the gasoline bare bones commodity futures price plus about 75 cents, which includes, taxes and transport costs and things like that. In states like California, Washington, Apple battery is running low. In states like California and Washington and other places where there are higher taxes on gasoline, then that price is going to be significantly higher at a retail level. All right, so that's where we are in terms of oil. And then I want to show this chart, which was one of the instigating factors for me making this video. This is one of the more alarmist signals that I was discussing. And I first want to point out that there's nothing wrong with this chart at all. It's factually correct, okay? I just want to point out a couple of things about it. First off is what are we looking at here? So this is January to December of several different years, 5 years going back to 2018 of the supply of oil sitting in inventories in the U.S. Okay, so supply of oil sitting, or the stocks of oil in U.S. inventories, and what the poster on Twitter, because that's always a very accurate place to get information, and so what the person who posted this was trying to show is that currently the U.S. stock of oil has veered way off of this typical 5-year average. So we have 5-year average bands here. Everything within there is within the 5-year average, and everything outside of it is lower or higher. And so this is where we are in 2022, which looks really, really bad because we're veering away and not getting any closer. Essentially what this means is there is a restocking season to oil, as you can see here, from basically January all the way through March, April, May. And then there's sort of a drawdown season during the summer, during summer driving and summer home building season when people are using a lot more oil. And then the cycle sort of repeats itself in the winter. What this is showing is that in 2022, there has not been any net restocking, net refueling, picking those reserves, putting those reserves back in. And so that is definitely a bad thing. But the thing that I want to point out about this chart that makes it a little bit different is that this includes the Strategic Petroleum Reserve. Okay, the Strategic Petroleum Reserve is a supply of oil, of crude oil, that is owned and managed by the United States government. And that means that both restocking it and drawing down from it are both controlled not by market processes, but by political processes. And what is the current occupier of the executive branch of the Oval Office, the desk and the Oval Office currently doing right now? Well, he is releasing 1 million barrels from the Strategic Petroleum Reserve every single day, at least on average, in order to try to control oil prices. Now, in fairness, this is not what the Strategic Petroleum Reserve is for. It's for emergency situations when the nation is literally prevented somehow from producing more oil, or severely hampered from being able to produce enough, or just to keep maybe the defense machine going in case we actually do get invaded, which is hard to imagine here in the United States, but anything could happen. That's what the Strategic Petroleum is there for. It's not to try to release in order to control the price of gasoline. So there have been a lot of drawdowns from that, but it is useful to look at oil prices without the Strategic Petroleum Reserve because, again, it's not a market process, and oil markets have been perfectly capable of providing the necessary amount of oil that it takes for people to drive over the last many, many decades. And we don't need to include the SPR in our analysis because most people are not burning oil out of the SPR when they fill up their gas tank every day. And most businesses aren't burning oil out of the SPR, and processors of plastics are not using SPR oil to go into those inputs. And so we don't necessarily need to look at that. What if there were a way to, in one number, look at the supply and demand for oil, to just look at the balance between the two? Wouldn't that be a really good way to talk about oil prices and where they are in relation to recent history? Well, yeah, it is. And yes, that does exist. So this is a metric called days of supply of crude oil, and I'm showing 10 whole years, June to June. So instead of being a straight time series, this goes from June of the start year to June of the end year, a bunch of 12-month periods stacked on top of each other. All right, and what that shows us is, because oil is so seasonal, because the use of it, the supply of it, and the demand for it are so seasonal, this shows us exactly where we are in the annual oil cycle, the annual cycle of supply and demand, and allows allows us to compare where we currently are to previous recent experience. Okay, and what days of supply allows you to do? Well, days of supply is equal to total inventory, so all of the oil that is currently in stock in all of the storage tanks across the nation, divided by the amount of oil that is currently used on a daily basis. So to put it in a sentence, what days of supply tells you is how many days you would be able to burn oil for in the US if no more new oil was produced, like starting tomorrow. So currently, if we didn't have any more oil produced starting tomorrow, then we would be able to burn 25.8. We'd be able to burn oil for 25.8 days, which is historically, as you can probably tell, right in the range of those 10 years. So you take these 10 years and you stack them on top of each other. Well, 2021 to 2022 is right there in the middle. So that's not exactly a cause for concern. A couple of years to point out, this is June 2019 to June 2020. This is that huge rebuilding we saw when oil use went way down. And then from June 2020, we go into June 2021, which is the line that you see here. The economy is reopening. A lot of good things are happening. And we had all of these different things, economic expansion and that sort of thing. So oil use went up, and thus days of supply went down. It's not necessarily a bad thing, but in 2022, we are sitting right in the middle of that historical 10-year range. This is the same thing, just on a time series. So like I said, it is extremely cyclical. It basically looks like a bunch of waves on a chart, and the chart that I just showed allows us to wipe out some of that noise and just compare the current situation, apples to apples, against other years in recent history. Current level, 25.8. The all-time low was less than 20. So let's move into gasoline. Again, you see this cyclical pattern, this up, down, up, down, up, down. Now, where are we in terms of days of supply? Again, this is the amount of days that we would be able to burn gasoline if there were no new gasoline produced starting tomorrow. So we would be able to burn gasoline for 24 more days at the current level of demand in barrels per day that are consumed. We'd be able to burn gas for 24.1 more days. The all-time low was reached at 19.8. That was the days of supply in September of 2008. So basically, right before the global economy crashed, the price of oil peaked and the demand for oil peaked, and we had an all-time low in days of supply of 19.8. We are about 4 to 5 points past that. So is that cause for worry necessarily? Does that say that major gasoline shortages are right around the corner? My opinion is no. And by looking at these metrics, I think you will probably feel the same way. This is the same thing, but we're looking at gasoline days of supply going back to 2008, which is this red line here, right? So that's the red line is days of supply, and the blue line is the current situation, so 2021 to 2022, and I'm just showing this to show you the sheer difference, the juxtaposition between these 2 years. I mean, we're well above where we were in 2008, and even though gas got really, really expensive in 2008, there weren't any crazy crises that were caused by an outright shortage of oil and therefore gasoline. But again, the one thing that I want to point out, the one caveat to that, is if Congress or a bunch of state governments are successful in passing price controls on these key commodities, right? Price controls turn high prices into shortages, okay? So if that happens, then there most certainly will be long lines at the gas pump and shortages. It's almost a mathematical certainty. Let's go ahead and look at the reconfigurations in the global supply chain when it comes to oil. Why do we have supplies that don't necessarily look very low, but then we have prices that are increasingly high? Well, a big part of it is just the configuration. So right now the U.S. Has gone from exporting 3.11 million barrels per day of oil to exporting in a really unknown amount. It's unclear how much exactly, but we're exporting a lot more, so the supply chain is having to rejigger itself in order to support a great deal more exports to Europe. And that is putting a heck of a lot of adjustment onto the system through transportation costs and all of those sorts of things. And that causes prices to go up, the cost of delivering the oil to the end consumer to go up. Russia to EU exports totaled 4.5 million barrels a day going back to 2021. That was the most recent average that we have. And this is 33% more, roughly, than the entire export supply of the United States. So the U.S. and a bunch of other countries, specifically North African countries, are going to have to make up the difference that the EU is not receiving from Russia. And so that is going to cause a severe rearrangement of the supply chain and is going to really have a huge impact on prices for an honestly unknown amount of time. I mean, there have been some estimates that this is going to take a period of years. All right, but with that, let's go ahead and move into what natural gas is doing. This is one of the most important commodities when it comes to homes, when it comes to powering and heating homes, as well as cooling them, which is very important when it's summer and you live in Texas. Again, we see this big dip here with the lower energy usage by factories and different commercial operations like that, with the great COVID lockdown of early 2020. 2020, that's the year it ends with the word 20. And we've seen this uptrend ever since then. Definitely got a big boost from the war in Ukraine there, from Russia's invasion of Ukraine. Not cool, Russia. And we're currently sitting at a price of $6.20, at least as of close yesterday, June 27th. And this is priced in what? This is priced in British thermal units. So natural gas futures in the United States are priced in a million British thermal units. That's the unit there. And this Henry Hub designator is, all this means is that this is basically the benchmark contract for natural gas in the US. And next we're going to look at the European natural gas contract benchmark, which is called Dutch TTF. I don't actually even know what TTF stands for. I just know that that's the benchmark in Europe. So that's Henry Hub. These are futures markets that allow us to monitor in real time how expensive or cheap these commodities are coming to be. The 2015 to 2020 average was not 645. It was actually, gosh, that's a really big typo. It was actually about 245. So that was the 2015 to 2020 average. It was 245 per million BTU, and now we're sitting at $6.22 per million British thermal units. But let's compare that to Europe, because this is kid stuff in comparison to what's going on in Europe right now. So we have the Dutch TTF. Again, that's the European benchmark, how Europeans get power for their, for their society. Their power is actually, or their natural gas is actually priced in megawatt hours, but I've taken care of converting that to British thermal units to make this, this chart easier to read. And then we're comparing that to the blue line, which is natural gas prices in the U.S. Now, why is this number different from the one that we just saw? Why is this 519 or 591 different from the number we just saw? It's because this entire chart, to make it even more apples to apples, is in euros. All right, so I don't want to compare euros to dollars. That's not going to tell us very much. So we compare euros to euros. And natural gas prices are well over 6 times what they are in the U.S. right now in Europe. So their 2015 to 2020 average was 480 euro per million BTU, and they're currently sitting at 3760 or 3766. Now, when did this really start to ramp up? Most of this increase happened in 2021, long before anybody even thought about the possibility of Russia invading Ukraine, except for really a couple of very astute people in the financial sector who somehow saw it coming back in October, but I don't have time to get into that. This is long before anybody was really aware that Russia was planning to invade Ukraine. And this happened in the midst of the ongoing energy crisis in China as well, where factories were actually being limited in how much energy they could burn, going all the way back to May of 2021. So this crisis has been a long time in the making. And what did the Russian invasion of Ukraine do to this trend? Well, it certainly increased the maximum price and increased the volatility here. Okay, so that definitely happened, and it's definitely had an effect. But Europe has had a really very large natural gas situation for a long time now. Now, what's going to happen going forward is that these two prices are probably most likely going to converge towards one another, because the United States has plans to export a great deal of its availability, of its export capacity to the EU in order to help it get completely off of Russian natural gas. So that's what Europe wants to do. The EU wants to rid themselves of Russian natural gas in order to ostensibly support Ukraine's war effort. And the U.S. is going to help them by building export terminals and increasing the availability of ships that can carry liquefied natural gas, because that's the format it has to be shipped in, and sending it off to Europe. And the more that happens, the more these two prices are going to converge towards each other, because there will be more available to the European market where there is currently less, and there will be less available to the US market where there is currently more. Now, in terms of comparing the current stocks of natural gas in the U.S., I'm actually a little bit more worried about this commodity currently than I am about oil, by the way. But in terms of comparing the stocks of natural gas to where these figures have been in a 5-year history, we're looking at a 5-year maximum here and a 5-year minimum. So this is going all the way back to 2017, 2018. And we're currently at 2,169 billion cubic feet. There's a lot of different ways of measuring natural gas quantities. It's very irritating. But this is where this green line is where we're at right now. And as you can see, like the oil price, we're still hovering between, in a pretty regular range here. This is not a terrible place to be. We are still above the minimum in the 5-year averages that we have here. We're still above the 5-year minimum that we have here for June. So that's not exactly a terrible place to be. And when I look at this chart, it makes me feel a little bit better about the situation. Again, prices have a long way to go as we start shipping a lot more liquefied natural gas out to Europe so that they can burn that instead of Russian natural gas. And frankly, I think that's a misguided policy, but that's not my decision to make, and you can come to your own conclusion as to whether that's a good policy or not. And then the last chart that I'm going to show is months of supply of natural gas. There doesn't already exist a days of supply metric for nat gas, so what I did was to sort of create one using estimates of monthly consumption. And so what this chart is telling you is just how many months of natural gas we would have available just based on storage if, in fact, we did not produce any more at all starting tomorrow. We're currently at a level, and this is kind of going to sound weird to say, but we're currently at a level of 0.97 months. So just below 1 month, if there were no new natural gas, no nat gas produced tomorrow, then we would be able to sustain the natural gas demand in the U.S. for about a month, a little less than 30 days. So are we in danger of running out of energy, at least here in the United States? By the data that I've just shown you, my conclusion is not really, but can prices go way higher? One might say even sky high, because of the reconfiguration of the supply chain that's going to have to happen in order to sustain Europe through this breakaway from Russian energy. Well, depending on how that policy evolves going forward over the next several months and years, absolutely, prices have plenty higher to go. if they only reach the peak adjusted for inflation that they reached in 2008, when there were not so many headwinds to global trade, there were definitely headwinds to global finance, but not necessarily to global trade. If they only reach that peak on an inflation-adjusted basis, we could be looking at oil prices of $200, and we could be looking at gasoline prices in Texas, which means higher for everywhere else, of $6.74, which is about $2, $1.75 to $2 higher than they currently sit. Again, for the third time, I want to emphasize that the caveat to all of this is that the legislature does not enact price controls, because price controls turn high prices into shortages, and shortages are way, way, way worse than high prices. If there is any sort of price gouging law or any sort of outright price control passed on these key base commodities, there will be much worse problems. You don't want that to happen. So, the situation in Europe as far as energy is concerned is probably going to get a lot worse. Even the energy regulators in Germany, who are supportive of these sorts of policies, are warning their populations that this is about to happen. There could be cuts to residential and commercial power usage, just as there were in China, going back to May of 2021. And so it's going to be a very interesting time to be alive, and energy is going to get very, very expensive. But is the U.S. going to run out? Again, based on the data that we've seen, I don't think that there is reason for alarm in that particular regard. And with that, I'm going to sign off. I'll be back later on this week with some indicators on showing us about the health of the real economy. So I hope you'll join me for that, as well as some real estate prices and other kinds of information about various markets, stocks, bonds, and the like. I hope you've enjoyed this episode of Supply and Demand Daily, and I will catch you next time. Thank you very much for joining. Have a good one.